It's true. Across the globe, women aren't as prosperous as men. Gender inequality is a pressing moral issue, but we forget it has massive economic implications. If you were to put all of the women who don't have access to formal financial services in one place, they would make up the third largest country in the world. That means an entire population without bank accounts, credit cards, or other tools you and I likely benefit from daily. Prosperity for women starts with inclusive policies, products, and people around the globe, and the investment to make it happen. Welcome to the Making Finance Work for Women podcast. My name is Sonja Kelly, and I lead Women's World Banking's proprietary research division. Join me as I speak with changemakers around the globe to deconstruct the social and economic exclusion women face. We'll discover new evidence together and drive action to accelerate women's economic empowerment. Because a leg up isn't a handout, it's a global game changer. Indeed, welcome and thank you so much for tuning in to the Making Finance Work for Women podcast, now streaming on YouTube and available wherever you get your podcasts. I'm your host, Sonja Kelly. If you're listening on YouTube, you'll be able to find additional insights and resources linked in the description of the video below, in addition to seeing us today. Before we get started, I'd like to give a special shout out to the sponsor of the Making Finance Work for Women podcast, Ernst & Young LLP. EY is a global leader working across assurance, consulting, law, strategy, tax, and transactions, and EY teams ask better questions to find new answers for the complex issues facing our world today. You can visit their website at ey.com to explore their latest insights and services. Let's jump into the show. Today, we're talking about central bank digital currencies, or as we'll refer to it throughout the conversation, CBDCs. They are on the rise, and it's not a surprise. And I just realized that rhymed. The increase in digital finance, combined with the role of central banks in issuing currency, make CBDCs a clear next evolution in the modern central bank. In fact, the Atlantic Council maintains a CBD tracker, and this tracker shows there are over 120 CBDC pilots or projects that are at some stage in their development. So, in other words, if you haven't heard about this in your own market, you're very likely to hear about it soon. Nearly all digital currency plans around the world have listed financial inclusion as a benefit, and CBDCs are not an exception. And we're going to be focusing our conversation today on retail CBDCs. Retail CBDC proposes to be a unique money form. It's different from commercial bank money, which is issued by the commercial banks, or issued by the central bank and distributed by the commercial banks. It's different from fast payment systems. And e-money, it's different than e-money as well in that it's a liability of the central bank. It's different from cash in that it's entirely digital, but it is meant to mimic cash in digital ways. And it's different from central bank reserves in that users, rather than financial institutions, can hold it directly. Retail CBDCs are also distinct from what is known as wholesale CBDCs. CBDCs are a digital liability of a central bank that is limited to certain financial institutions and generally not available to the public. Okay, so let's let's take all of that and apply it to the experience of a low-income woman. Let's take a savvy low-income woman market seller in a market like Nigeria. She prefers cash, and she is one of the 1 million women with no services or inadequate financial services. So, like the majority of people who don't have an account, she thinks banks are too expensive. She says, when somebody asks her why she doesn't have an account, she says, I don't have enough money. She's wary of the minimum balance requirements at financial institutions. She might have a feature phone instead of a smartphone, the ones that have the touchpad to dial. But sometimes the network, the mobile network, goes out, and sometimes she doesn't have access to the outside world from her phone. She uses cash and she wants privacy in her payments. She wants to be anonymous, and she doesn't really trust the banks to have her best interest in mind. So for this woman, retail CBDCs, retail central bank digital currencies, may work as well for her or better than cash. They may provide a low threshold way to enter the formal financial system. CBDCs can be used without a bank account, and it doesn't require a minimum balance. For small transactions, it doesn't always require an ID either. And there are a lot of CBDCs around the world that have anonymity as a key feature, kind of a way that it's designed. CBDCs can also, in many cases, offer offline functionality through Bluetooth or near field communication, or NFC, that's an acronym we will probably not use a whole lot in this conversation. Um, it is ostensibly designed to operate on feature phones as well as smartphones. And assuming merchant acceptance and customer adoption could be used for this small merchant in Nigeria, could be used just like cash. When it's well designed, it's anonymous as cash, but the user can own a digital record of their payments to provide a digital footprint to financial services institutions if they're applying for something like credit. It's directly provided by the government, and that might overcome the trust issue that she has with a bank. It sounds fantastic, I think, or it sounds great to me. But the problem is we haven't seen widespread adoption of CBDCs among low-income people, and in particular among low-income women. And among the reasons for this, I think, are low digital financial capability, maybe a lack of access to a personal technology device in the first place, or women are less likely to have phones in general, and we'll talk about that with our guest. And frankly, a lack of awareness that it exists and what those features are that might be ones that would be make it interesting for users to try it. Governments as well are not usually the designers of direct to consumer products or processes. And creating a digital wallet with the most disadvantaged users in mind might be a big ask for government institutions. I'll end with a quote from their paper on CBDCs. There are these researchers from MIT, the University of Virginia, and Maiden Labs. They have this quote. They said, designing a CBDC that replicates the features of existing systems would not make a meaningful difference for financial inclusion. So we're really talking about a technology here that requires innovative thinking in its design and in its customer engagement than we've used in the past so as to not replicate exclusion. So, with that, I'll introduce our guest. Sara Elinson is a partner in the financial services practice at Ernst& Young LLP. She leads the EY FinTech strategy and M&A practice for the Americas and assists fintech companies with strategic investment decisions, including M&As, JVs, and new market entry. With over 20 years of industry experience, she has helped clients translate growth strategies into practical action and provides advice on the identification of potential partners, financial modeling, business case analysis and valuation, and deal execution. Welcome, Sara.
Thank you so much. It's great to be.
Yeah, great to have you. Thank you for joining us today. Let me just start out by asking you, what's your origin story, like your superhero origin story? We like to ask this of all of our guests because everybody comes to this financial inclusion space with kind of a different story.
Yeah, so I don't know if it's a superhero story or not, but I think there are a couple key things that sort of define me as the professional that I am today. As an undergrad at university, I studied French and rhetoric, and that's not necessarily an area that a lot of business people sort of start out in. And coming from there, my first job out of school was working in a French bakery in Seattle. And that
No.
that was my first exposure to small business, frankly, and that's where I, had a grassroots learning experience. Started taking courses at night around finance and accounting, and started building up my business expertise. Ultimately, went back to school formally, got my MBA, and 25 years later, here I am on a podcast talking about CBDCs, and I wouldn't have predicted it from the beginning there.
That's wild. So no superpowers, but definitely an intentional journey into this space and kind of a surprising one as well. That's great. So Sarah, should we think about CBDCs as a direct replacement for cash, or should we be thinking about them as an extension of formal financial services?
So, hate to say it, but it's a little bit of both, right? So the answer I would say is yes, and it really depends on how different central banks are thinking about their mandate and their mission. And in your intro, Sonia, you talked about sort of design choices that central banks are making. Think about each central bank having a unique policy objective, unique motivations driven by the idiosyncratic differences in the economies that they're serving, the social structures that they have, and the legal frameworks. And so then you can think about there's going to be different design choices that a central bank will make that are going to make it look and feel more like cash or look and feel more like an extension, as you said. Um, for cash, when you think about it, what's cash for? It's for the exchange of value, and ideally, it's also a store of value. Not necessarily in every currency, but hopefully it can be a store of value as well. When you think of CBDCs, there can be a bunch of different design choices beyond that. And if you don't mind, I'll run through a couple of those.
Please, that would be great.
First of all, and you touched on it as well in your intro, there's a question of retail versus wholesale, right? Is this CBDC meant to be something that gets issued by the central bank through commercial banks within the financial system? That's one we would be calling a wholesale CBDC. Or is it direct to consumer, right, where it goes from the central bank and can directly be accessed by consumers? That would be a design choice that a central bank would have to make. There's also the technology design choice. Should we be using blockchain or distributed ledger technology? And if so, which variety, which protocol, which many different choices around how you would approach it. There's questions around privacy. Is this should access to the CBDC be account based, meaning tied to a specific identity, or token based, which tends to have some different privacy considerations attached to it? Should it be globally interoperable, or should it really just be, in the case of Nigeria, should it be usable only within the country of Nigeria, or should it have international linkages with other CBDCs or other forms of digital money? And then the last one, which I think is maybe um, the most interesting, is around programmability, and this is where we get into should the CBDC enable smart contracts to be attached to them, right? Think about spending controls on a credit card today, right, where you can only spend a certain amount at certain types of merchants. We could potentially do that with CBDC and programming into the code. Um, this particular token can only be used for development aid, or can only be used at this type of merchant. And think about the policy and sort of economic benefits that could be attached to that.
I had no idea that was a possibility that you could. I mean, I guess that makes sense if it is a blockchain-based CBDC, that you could put smart contracts onto it, but that opens up so many policy possibilities.
Sure. I think another, like a very interesting use case could be aid and development programs, right? So the big challenge with aid programs is, how do you ensure that the funds actually get to where they need to go? If you've got tokens that are that are basically programmable money, there's full transparency, there's ability to trace, and there's the ability to control and unlock for certain uses and to prevent other uses as well. You can actually see whose hands it gets into, which is pretty
Hmm,
interesting.
that is interesting, and I imagine that would be really attractive to a lot of donors and also a lot of governments.
Agreed. Yeah.
I've noticed a lot of confusion between CBDCs and other forms of digital money. Like sometimes they just kind of get lumped in together. So I wonder if I can ask you a series of rapid fire questions to clear this up.
Sure. Fire away.
Okay, ready? Here we go. Do CBDCs require blockchain?
Technically, no. So digital money does not require blockchain. I think there's an example. Finland in like the early 90s was experimenting with digital money. So technically, no. But most of what we are talking about today with CBDCs is actually tied to a blockchain technology.
All right. Are CBDCs always direct to consumer?
No, they're not. Not always. We have, as I just said or previously mentioned, we have both wholesale CBDC and we have retail CBDC. Wholesale looks more like our current central bank structures, whereas retail CBDC would be central bank to consumer. So it doesn't always have to be direct to consumer.
All right. Are CBDCs anonymous by design?
No. So this is an interesting and it's often a misconception around blockchain and leads to some of the skepticism on around blockchain. At the end of the day, with blockchain technology, every transaction on a blockchain can be seen. So it is there truly is no anonymity. What there is, though, is, and this is a hard word for me to say, pseudonymity. So there's a pseudonym where there's a wallet. The wallet address is always known. We just may not know who the wallet is attached to. So it's traceable. Every single transaction would be traceable, tied to a wallet address. So that you could see this where the CBDC is originating, where it's ending. What you may not know is who actually owns that wallet address.
All right. Who's in charge of CBDCs versus other forms of digital money?
Yeah, interesting question. So depends what we mean by in charge. So I have two forms I can think of with respect to in charge. One definition is who's responsible for governing and managing the system. Um, a CBDC is a direct claim on the central bank, just like cash today. And in that case, the central bank and the government would be managing monetary policy and would be in charge. And they would also define how and by whom blocks get validated. Other forms of digital money are a claim on private institutions. So we've heard maybe talk of tokenized deposits, which are a claim on a commercial bank. Stable coins are a claim on a fintech issuer. Um, so those would be situations where these other forms of digital money, those other institutions would be in charge. The second definition is a little bit more around who is custodying or holding the CBDC or the tokenized deposit, right? So here we may have some different options with certain people or institutions choosing to self-custody and to hold on to the control of that of the CBDC via an app or a wallet, or others, or working with others with a custody provider, much like banks do today. So there's the physical in charge of the CBDC itself, and then there's in charge of the financial system. Two different answers in those cases.
And now, a word from our sponsor. EY applauds Women's World Banking's 45-year legacy empowering women through financial inclusion. Together, we have a common vision to build a better financial services industry, one that is stronger, fairer, and more sustainable. Find out more on ey.com. Okay, what's your prediction? In 20 years, should we expect CBDCs to have replaced cash?
So my visceral reaction is not a chance.
Wow, okay.
So we look we still have a lot of and I'll talk about from a U.S. perspective, and this applies, I think, to some of the European markets as well, we still have a lot of checks in the system, right? And we've seen that there are far more efficient and safe payment methods than writing a check and cashing a check and processing a check. Yet there's an amount of inertia where there's still millions of checks that are written today. And what we've learned in payments is that even when a new system is created, the old systems they don't go away. We just add more to it. And so that's my visceral reaction. Now, the counter argument to that, and there's a quote from Bill Gates that's something like, most people overestimate what they can do in 1 year and underestimate what they can do in 10 years. And so it is pretty, sitting here today, I think there's still a ton that needs to be solved for and worked out as it relates to CBDCs. But 20 years is a long time. And I think, if Bill Gates is right, and he's been proven to be right in certain other cases, other situations, we may be able to accomplish quite a bit in 20 years time.
Mm, that's so important. So there's a ton that needs to be solved for, but we may be able to accomplish quite a lot in a short time. Um, okay. This is this is so great. This is a better conversation than I expected because it's so interesting. Like I thought we would end up sticking to the technical stuff, but you've already gotten to so much of the implications, which is great. Um, women's role banking is in existence for women's economic empowerment through financial inclusion. And I've noticed that in most CBDC strategies, there's some mention of financial inclusion. Um, what do you think about that? Like, is it just a way to justify CBDCs and ensure support? Or is it a real possibility that financial inclusion might be a reality through CBDCs in ways that other services haven't been able to achieve?
Yeah, I don't think it's just a justification to try to bring CBDCs to life, and but I do think, and you mentioned this a little bit earlier in your introduction, this is not just a question of financial inclusion; it's also a question of technology inclusion, right?
Mm.
And so there are more mobile phones on the earth today than retail bank accounts. So that's a good fact pattern that we have in our favor. But in order for CBDCs and other forms of digital money to work and be trusted, there also needs to be a trusted, reliable, resilient internet or phone service, right? And that's just not that's not the reality everywhere on Earth today. It's just not ubiquitous yet. So there also needs to be an equitable way to get people on board. And what I mean by that is onboarded and entered into the financial system. So in certain locations where providing identity in a non-face-to-face setting can be a challenge, you're going to still have that same challenge with CBDCs as you do in the traditional banking system. It's yeah. So I think financial inclusion is an important aspect of CBDCs. I don't think it's a justification, but I don't think CBDCs in and of themselves can solve the inequities that we see today.
Yeah, so you just mentioned connectivity, which
Yeah.
is unequal around the world. Personal technology devices, like even though there are more, I didn't actually know, I had never calculated that, although it makes sense. More phones than bank accounts. Personal technology devices are not an equal opportunity um, commodity. Like we know that women are 13% less likely than men to own a smartphone. That's 200 million fewer women than men. Then you also mentioned identity as a big um, driver of difference. So, are there so in addition to connectivity, personal devices, and identity, like is there anything else that's kind of an ecosystem necessity before CBDCs become a reality for low income women?
Yeah, I think so. And I guess I would mention um, a couple of things. Today, think about the internet and how we access the internet, and think back began to the early days of internet, and there was a lot of, before it became a consumer reality, um, there was a lot of interest in the underlying technology and the 7 layers of infrastructure that are required to make the internet work. And we're sort of in that same place with blockchain today, where people are very focused on the infrastructure and the layers and the technology supporting it. And at the end of the day, you or I or the marketplace seller that you mentioned, we don't really care about all of those layers. What we need is something that we can trust and that's reliable and that's ubiquitous. And so I think one of the precursors for this becoming, and this is the chicken and the egg, this is the sort of the cold start network problem that we have. What we need to solve for is getting CBDCs and blockchain to a place where we don't think about the underlying technology. It's just there, and we use it and we trust it. So I think that's one piece that needs to be in place. And then the second is that trust element itself. Um, I think it was Ecuador. I think in 2014, Ecuador launched a project around digital money, and they had the same, financial inclusion goals. They had goals around reducing costs related to actually, producing and managing hard currency because that's expensive for a country to do. Um, they ultimately shut down their project about 3 years later because it just wasn't getting the adoption. It was really the lack of trust that their citizenry had in it. So um, we have the technology that we need. We may have the internet capability that we need, but we absolutely need to work on the trust angle of the citizenry.
Mm. Yeah, yeah, so even if we solve the 8 percentage point gender gap in ID, the 13% gender gap in phone access, there's also this trust issue, and I loved that you said we need to get to a place where it's just there and we use it and we trust it and we don't think about the underlying technology or enablers because it's just a fact of life.
Yep.
Yeah. I have one more question along the lines of adoption. So, we know there are gender differences in digital financial capability. The World Bank Global Findex showed us that women were 25% more likely than men to say they needed help opening an account. So, like, what needs to happen to solve that digital financial capability gap? It's so tricky because we're asking women to go from like only cash to
Yeah.
digital cash, which seems like it would be a one-to-one replacement, but I would guess that people who've already engaged with digital financial services and have an account and are engaging with their bank through their mobile app would be more likely to adopt. So, yeah, it just seems like it's something that maybe is a problem that hasn't been solved yet that governments will have to consider.
There's a great just sort of general um, case study with Kenya and M-Pesa, right? And that was really one of the first at scale mobile payments um, networks that was adopted and used throughout the country. And the rationale for why that worked was this confluence of um, the technology was there and there was no prior infrastructure that it needed to replace, right? It worked simply because it actually could go right from cash to mobile. It didn't have to displace a whole bunch of other legacy technology that existed in the market. And so that feels like we're potentially in the same place with CBDCs, right? If you've got economies that are largely cash based, that maybe are don't have the infrastructure of other financial products and other financial services and the technologies underpinning them, why not jump right from cash to CBDCs? But it's not proving out yet. So we'll need to figure out why.
Yeah, and the incentives are there. I mean, in the Kenya example, they had a 2% increase in GDP. So, like, for the government, making the economy work better is in its
Yeah,
best interest. Yeah.
yeah.
Well, Sarah, it's been such a pleasure. Thank you for joining us on the Making Finance Work for Women podcast. This has been a fascinating conversation, and I really look forward to watching this space. It seems like it's going to be a dynamic one.
Thanks so much for having me, Sonja.
I have a few notes that I'm going to be thinking through, and I hope it's helpful for me to go through those. Um, Sarah said how central banks are thinking of their mandate and mission will drive design decisions. And so, if their mandate and mission includes the financial inclusion of women, it might mean they use a women centered design approach. And that's an approach that we really appreciate. If that mandate isn't there, the services aren't going to be designed with them in mind. She also said there's a ton that needs to be solved for. I mean, clearly, our conversation focused a lot on those challenges, but challenges can be solved very quickly and surprisingly quickly. So we may be able to solve those challenges more quickly than we expect. She also said this is not just a question of financial inclusion, but technology inclusion. I think it's important to acknowledge that we as finance professionals, or me as a professional, I'm not working in a vacuum. Like there are so many interlocking and and competing challenges that might be enablers, but are really driving some of those exclusions. And finally, I loved Sarah's vision of the future. Like we need to just get to a place where the CBDC or whatever digital money we're talking about is just there. We don't think about the underlying technology and get mixed up in the technical aspects, but we use it and we trust it. And that's the vision for a financial inclusion future. If that use and trust includes low income people and especially low income women. So, again, thank you so much for joining us. Check out some of the resources that we've posted below on the YouTube page. And we look forward to engaging with you next time in July on the Making Finance Work for Women podcast.